Let's begin by just considering what all business organizations do. They're basically there to provide goods or services. They've got objectives. A business needs to be organized and managed. It's got to be accountable. If there are any legal requirements, it must stick to them, and it's got to have some sort of structure. Now, that doesn't matter whether it's a sole trader, a partnership, or even a public limited company, or a private limited company, or whatever. It's still going to have those characteristics of a business organization. So we can classify or group businesses then into private sector and public sector. The private sector is probably what you are more comfortable with, in that we normally talk in terms of private sector rather than public sector companies. We can have a very simple idea when we say that there are two types of businesses in the private sector. They can be unincorporated or they can be incorporated. And what we're going to look at in this podcast is essentially the unincorporated business, because there's no legal difference between the owner and the business. And that means we're talking about sole traders and partnerships. Whereas in an incorporated business, there is legally a separate identity from the owners, and they refer to public limited companies and private limited companies. Now, I know you'll be told at some point that you have to keep the business transactions separate from personal transactions for sole traders and partnerships. That's true, but there's still a liability for the owners. It's not the same as an incorporated company where they are a separate legal entity from the owners. A sole trader is often known also as a sole proprietor, where the business is owned by one person. They can, of course, employ other people, but there's only one owner. And they're usually small businesses: hairdressers, farmers, painters, plumbers, and so on, and many fast food outlets such as fish and chip shops. However, you might remember that some of the early businesses were not very small, even though they were sole traders. So you take the history of your own area, mills, etc., very often were owned by one particular person and employed large numbers of people. There are a number of legal requirements for sole traders. They have to register for VAT when turnover reaches a certain amount. That's when their sales reach a certain amount. And in 2012, I believe this was 77,000. They've got to pay income tax, national insurance. If you are a sole trader, you can't escape that, I'm afraid. And in some cases, if you are supplying particular services, such as a taxi service, you have to have a license. Or if you are supplying or selling alcohol, you must have a license. And if you change the use of a premises, you must have planning permission. So if you plan to start up a business, such as a fast food outlet, and the premises in fact don't have planning permission for that, you could be in trouble. So you must make sure that your premises have got the right permission for that use. All businesses have to comply with health and safety legislation, and they must conform to employment legislation. I don't think, for example, that the conditions shown on this one would conform to modern employment legislation. So the 57-hour week for children, I'm afraid, is no longer there. No more cheap labour. Sole traders have certain advantages. They have little set-up costs. In the case of many carpenters, electricians, plumbers and so on, they often have their own tools and may have come from a larger organisation before they set up business. If they're working out of their own home, then there's no cost for the premises, so not a great deal of capital is required. The big advantage for a sole trader is you get to keep all the profit, after any taxes have been paid, of course, for yourself. And of course another advantage is you are responsible for everything. You can make your own decisions. You're independent. You are, if you like, you're in control of your business. You can choose which hours to work. You can choose when to take holidays. You can respond to customer requirements, and you can produce one-off items if need be. Because you're a small business, you often have better relationships with customers. It's a one-to-one service or a personal service. And some businesses actually charge a premium for that. If you are a sole trader, you might well be able to get government grants to assist you. Well, They tend to be rather scarce these days. There are, of course, disadvantages. If you are a sole trader, you've got unlimited liability. This is very important. The owner is responsible for all debts. If you go into debt, then someone can claim from your own assets, including your own property, your car, your television, your computer, whatever. You could lose everything, all your savings. So it's a big risk in that sense. So if you are unsuccessful, then you are in trouble. Also, a lot of people work for very little reward. Not every sole trader is making piles and piles of money. Not everyone's going to the Costas every 2 months or whatever. Similarly, there's the risk of personal illness. If you are the only person working in the business and you become ill, then you have problems because you've got to get cover and you might not be able to get suitable cover. If you're ill for a very long time, the business may have to close. When the situation comes when you die, then sometimes you can pass the business on to another member of the family, which often happens in farming, but very often the business simply ceases to exist. It's difficult for small businesses and sole proprietors to obtain money. Banks aren't very willing to lend money to sole traders, so very often it's a matter of having to use your own savings to set a business up, which isn't always the best risk that you want to take. So those are disadvantages, right? If you are independent, of course, there are further disadvantages. There's no one to share the decision making with, so it doesn't mean to say that your decisions are always going to be the best. It's not easy to take holidays. Farmers, it's usually a 52 weeks a year job. And equally, as things change, you've got to change, so you may have to learn new skills. That particularly applies to people who set up in IT-related businesses. And as we mentioned before, long-term illness can be a problem. If you're a sole trader, there are legal risks too. You can be sued by customers and all assets are at risk, just as if you make a loss, all assets can be at risk if you go into debt. And of course, sole traders are much easier to sue than large companies. People often forget that. Sole traders have to perform all tasks, whereas larger businesses can employ people for specialist tasks like human resources, accountants, and so on. So sole traders are usually small businesses and don't benefit then from economies of scale. They very often do not get discounts on purchases. Now, in contrast to that, partnerships are an extension, if you like, of the idea of sole traders, but they carry with them a few advantages. Let's just look at the advantages. First of all, of course, what is a partnership? Well, a partnership is when two or more people join together with a common view to making a profit, and they carry on a business, and that's defined in a Partnerships Act, which goes all the way back to 1890. There can be up to 20 joint owners, and if you look at dentists, accountants, real estate agents, very often you do find people joining together to form a partnership there. A partnership has to have a legal document which states each partner's rights, how much capital they contributed in the first place, how any profit or loss is to be shared amongst the partners, what will be the procedure to end the partnership, and so on. Responsibilities for each partnership. If there is no partnership agreement, then there is in fact a law which simply states that the Partnership Act will be applied, and that means that profits are shared equally amongst partners. So if you've contributed 70% and your partners contributed 30%, you might as well have a legal document which states that the profits are distributed in the same way, otherwise your partner's going to get 50%. The advantages for a partnership are there are no legal formalities needed to set up a partnership, although as we've said it's advisable to have an agreement. There's no legal requirement to publish accounts, although the tax authorities have to have access to accounts. If you have two or more partners, then they can specialize, so they become more efficient. You can raise more finance with more people. You can share the workload. You might even be able to take that holiday to the Costas. And it's slightly easier to raise capital since there are more assets involved. course, the disadvantages are you've still got the unlimited liability, and there's equal liability for all partners. Disagreements on partners can give problems as well, so that can be a disadvantage. There's a problem when a partnership is faced with a situation where one partner dies, because officially the partnership has then ended, and so you have to start with new agreements again, and the old partnership is legally just wound up, it's finished. So you start having to make a new legal agreement. There is a need to be careful with partnerships, because if one partner enters into any legal agreement, then it's binding on everyone. And since the business is unincorporated, then in a partnership, partners can be sued by customers. The Limited Partnership Act does provide for something else, and that is you can have a partnership where one partner provides the capital but doesn't actually take any part in the business. That's called a sleeping partner. But this partner then has limited liability if this is formed properly under the Partnership Act, and that partner cannot be made to sell everything for a business debt, although they can still lose everything they put into the business. There is still a limit to 20 partners, and at least one of the partners in the business must have unlimited liability. There is now a new form of partnership, and this dates to the year 2000, the Limited Liability Partnership Act. You might want to find out a little bit more about. In this type of partnership, a limited liability partnership, all partners have limited liabilities, and businesses must file annual reports to the Register of